Imagine waking up one morning to find out that the most valuable thing you own, your home, isn't worth what you thought. The foundation of your financial security, the centerpiece of the so-called American dream, has turned into a liability. Families who thought they were building wealth suddenly realize they've been living in a carefully constructed illusion. And the most terrifying part? This has happened before. We told ourselves it was a once-in-a-lifetime disaster. We promised we'd never make the same mistakes again. But history has a way of repeating itself, especially when people convince themselves it won't. Today, right now, beneath the surface of a booming housing market, the same hidden cracks are forming. And if we keep ignoring them, we may be sleepwalking into another collapse. For decades, owning a home has symbolized stability, progress, and belonging. A house wasn't just a place to live, it was the ultimate status symbol of middle-class success. Families put everything into it, believing it was the safest and smartest investment they could ever make. Politicians encouraged it, banks profited from it, and entire industries thrived because of it. The American dream was sold not just as a story, but as a product. But dreams have a way of blinding us to reality. What looks like prosperity can often be the build-up to disaster. To understand the hidden crisis behind America's current housing bubble, we first need to revisit the last time everything came crashing down. In the years before 2008, optimism was everywhere. Home sales shattered records. Builders couldn't keep up with demand. Banks were handing out mortgages like candy, even to people who couldn't possibly pay them back. No-doc loans, adjustable rates, risky refinancing schemes, all disguised as opportunities for upward mobility. People believed prices would never fall. That belief, more than anything else, set the stage for disaster. When the bubble burst, it was brutal. Families lost their homes. Banks collapsed. Entire communities were gutted. Millions of Americans who thought they were climbing the ladder of prosperity suddenly found themselves drowning in debt, their savings wiped out, their futures uncertain. And yet, with time, memory fades. The crisis has become a chapter in history books, a cautionary tale that most assume belongs to the past. But here's the uncomfortable truth. The same conditions that led to that collapse are quietly building again. The illusion is powerful because it's wrapped in hope. Everyone wants to believe that buying a home means security, that a mortgage is a ticket to stability, that the market will always rise. It's the narrative we've been sold for generations. But illusions don't last forever. And when they break, they shatter not just individual lives, but entire economies. If we peel back the layers of today's housing market, we see familiar warning signs. Prices have surged beyond the reach of average families. Debt levels are climbing to historic highs. Investors are buying up homes, pushing ordinary people out. Meanwhile, policymakers reassure us that everything is under control, that this time it's different, that the system is safer, that regulators have learned their lessons. But ask yourself, didn't we hear those exact same promises in 2006? The reality is uncomfortable, but it needs to be faced. America's housing market is once again standing on shaky ground. And the cracks aren't just financial. They're social, they're generational, they're structural. For young Americans, the dream of owning a home is slipping further out of reach. For older generations, their wealth is tied to properties that may be overvalued. And for the broader economy, housing remains a ticking time bomb, an asset that can create growth on the way up, but devastation on the way down. The hidden crisis isn't about one single factor. It's about the dangerous belief that homes will always go up in value, no matter what. It's about families stretching themselves beyond their limits to afford mortgages that swallow half their income. It's about banks and investors exploiting that desire, packaging risk as opportunity, and betting on a system that cannot sustain itself forever. This is where the story begins. A market that looks strong on the surface, but beneath it, the foundations are crumbling. The same optimism that drove millions into the last crash is alive again today, only this time it's even more deeply ingrained. The question isn't whether America is facing another housing bubble. The question is how long we can pretend the cracks aren't there before the illusion shatters once again. The housing market doesn't collapse overnight. It doesn't go from stability to disaster in a single day. Instead, the warning signs appear slowly, almost invisibly, until they're impossible to ignore. What makes them so dangerous is that most people choose not to see them. They convince themselves that the little cracks in the system don't matter. They rationalize that markets always fluctuate, that this is normal, that things will work themselves out. But history shows us that before every major financial collapse, there are clear signals, red flags that wave in plain sight. Today, those warning signs are here. And yet, once again, America is ignoring them. The first and most obvious warning is affordability. Across the United States, home prices have soared to levels that are completely disconnected from household incomes. In some cities, the average home now costs more than 10 times the median income. Think about that. A family making $50,000 a year faces homes priced at $500,000 or more. For decades, financial advisors used to say a healthy ratio was 3 to 1, 3 times your income for the price of a home. But in today's market, that number has been shattered. Families are taking on crushing levels of debt just to own a modest property. They're pouring half of their income into mortgage payments, leaving little room for emergencies, savings, or even daily necessities. When the cost of housing consumes so much of a family's budget, any shock, a job loss, a medical bill, an unexpected expense, can trigger disaster. And when millions of families are living that close to the edge, the entire system is fragile. The second warning sign lies in debt itself. America is drowning in it. Mortgages are only part of the story. Credit card balances are at record highs. Student loan payments, which were paused for years, have resumed. Auto loans are stretching over longer and longer terms, often with interest rates that make them nearly impossible to pay down. Debt has become the lifeblood of the economy, fueling spending and growth on the surface, but underneath, creating instability that cannot last. When families are already buried in debt, the addition of a costly mortgage isn't just risky, it's unsustainable. All it takes is a rise in interest rates or a dip in wages, and the entire house of cards begins to shake. And interest rates, of course, are another flashing red light. For years, Americans enjoyed historically low rates that made mortgages seem affordable, even as prices climbed. Cheap money fueled a buying frenzy, pushing home values higher and higher. But as rates have risen, the illusion of affordability has begun to crack. A house that looked reasonable when financed at 3% suddenly becomes unaffordable at 7%. The monthly payment doubles. Families who stretched themselves thin to buy in recent years are discovering they can barely keep up. Meanwhile, potential buyers are being locked out entirely, unable to qualify for loans that would have been possible just a few years ago. This pressure on both sides of the market, owners struggling to pay, buyers unable to enter, creates a dangerous squeeze. And history tells us that when people can afford to buy and others can afford to stay, values collapse. Another sign is the explosion of investor activity. In many American cities, entire neighborhoods are being bought up not by families, but by corporations. Private equity firms, hedge funds, and real estate trusts see homes not as places to live, but as assets to rent, trade, and speculate on. This concentration of ownership pushes prices even higher, crowding out regular buyers. It also means that housing markets are increasingly tied to the decisions of massive financial players rather than the needs of communities. If these investors decide to sell in bulk, or if they default under pressure, the consequences could be catastrophic. Imagine thousands of homes hitting the market at once, flooding supply, collapsing prices, and dragging the economy down with it. That scenario isn't hypothetical. It's already happened in smaller ways, in certain cities, during downturns. And with corporate ownership now far larger, the risks have multiplied. We also can't ignore the role of construction and supply. In some regions, developers are building furiously, convinced that demand will never dry up. Entire suburban communities are being planned and built at lightning speed, financed by cheap loans and optimistic projections. But demand isn't endless. When interest rates cut buyers out, or when economic conditions shift, these new homes can sit empty, becoming ghost neighborhoods, rows of houses no one can afford to buy. This oversupply, combined with falling demand, can accelerate a collapse. It's the same cycle we saw before. When too many homes chase too few buyers, the market snaps. One of the most chilling signals, however, is the return of risky lending practices. After 2008, regulators swore these would never return. Banks tightened standards, requiring proof of income, stronger credit scores, and larger down payments. For a while, it seemed like lessons had been learned. But slowly, quietly, the old habits have crept back. Adjustable rate mortgages are on the rise again. Lenders are offering unconventional products to lure buyers who otherwise wouldn't qualify. Down payments are shrinking, loans are stretching longer, and the same creativity that fueled the last collapse is re-emerging. The details may be different, but the spirit is the same, pushing families into loans they can't sustain, because in the short term, it generates profit. If you look closely, another warning sign is psychological: complacency. There is an almost unshakable belief in many circles that housing is safe, that it is immune from collapse. You hear it in casual conversations, in the advice given to young buyers, in the confident predictions of pundits. Housing always goes up. This belief is powerful because it sustains the market. As long as people believe they can't lose, they'll continue to buy, to borrow, to stretch themselves. But that very belief is what makes bubbles possible. Optimism turns into denial, denial turns into mania, and mania turns into collapse. And perhaps the clearest sign of all is inequality. The housing market has become deeply divided between those who can buy and those who cannot. For millions, ownership is no longer even a possibility. They are trapped in rental markets where costs rise every year with no path to stability. Meanwhile, wealthier buyers and investors accumulate properties, creating a two-tier system where homes are less about shelter and more about speculation. This widening gap doesn't just strain families, it strains society. It breeds resentment, disillusionment, and instability. And when instability grows, markets crack. Taken together, these signs form a picture that should be impossible to ignore. Homes priced far beyond incomes, families drowning in debt, rising interest rates squeezing buyers and owners alike, investors treating housing like a casino, developers overbuilding, risky loans returning, a culture of complacency, a society divided by access to shelter. Each of these alone would be concerning. Together they paint a picture that is hauntingly familiar. The truth is that bubbles don't just appear out of nowhere. They are built. They are built on hope, on denial, on greed, and on a collective willingness to believe that the laws of economics don't apply this time. But they do. They always do. And the warning signs we see today are not subtle. They are bright red lights flashing across the entire landscape of the American housing market. The question is not whether they exist, it is whether we are willing to pay attention before it is too late. When most people think of a housing bubble, they picture a simple cycle. Prices go up, then eventually fall back down. But what they fail to realize is that behind those price swings lies an intricate machine, a financial architecture that is both powerful and fragile. And it's within this machine that the seeds of the next collapse are already being sown. Banks, mortgage lenders, private equity firms, and even the government itself form part of a web where incentives are misaligned and risks are quietly shifted away from those who create them. This is the hidden crisis. Not just the soaring prices you can see on a Zillow listing, but the unseen bets being placed on the very roofs over our heads. To understand the danger, let's peel back the layers. At the most basic level, a mortgage is a simple contract. A family borrows money to buy a house and agrees to pay it back over time with interest. Straightforward, but Wall Street figured out long ago that a mortgage could be more than a loan. It could be a product, something to package, trade, and sell in bulk. Out of this realization came mortgage-backed securities, bundles of thousands of home loans turned into financial instruments that investors could buy. On the surface, it looked brilliant. Investors earned steady returns. Homeowners got access to credit, and banks freed up cash to issue even more loans. But underneath, this system rewarded lenders not for making safe, responsible mortgages, but for making as many loans as possible. The risk wasn't theirs anymore. They passed it on to investors around the world. Fast forward to today, and while the financial products have evolved, the logic remains eerily familiar. Private equity firms are buying single-family homes in bulk, turning neighborhoods into portfolios. Mortgage servicers are slicing and reselling loans in ways most borrowers don't even understand. And with interest rates having swung wildly in just a few short years, the pressure inside the system is reaching dangerous levels. Here's the scary part. Homeowners themselves are no longer the main players. In cities like Phoenix, Atlanta, and Tampa, entire subdivisions are owned not by families, but by corporate landlords. For these firms, houses aren't homes. They're revenue streams, assets on a balance sheet. And when markets tighten, corporations don't panic like individuals do. They move strategically, selling off thousands of homes or raising rents in unison. The ripple effects of those decisions can devastate entire communities overnight. Meanwhile, government policy has unintentionally fueled this machine. Low interest rates during the pandemic, combined with trillions in stimulus, created a perfect storm. People rushed to buy homes with cheap debt, bidding wars broke out, and corporations seized the opportunity to outbid ordinary buyers. The result? Prices surged far beyond what incomes could support, creating yet another gap between housing costs and economic reality. And here lies the invisible fault line: affordability. For decades, the median home price in America hovered at about 3 times the median household income. Today, in many markets, that ratio is over 6 to 1. That means millions of families are stretching their budgets dangerously thin just to keep up with mortgage payments. All it would take is a mild recession, a wave of layoffs, or another spike in interest rates to push thousands of households into default. If that happens, the machine starts to break. Mortgage-backed securities lose value. Corporate landlords face losses. Banks tighten credit, making it harder for new buyers to enter the market. And just like in 2008, panic spreads not because of one family losing a home, but because the entire financial system is suddenly questioning the worth of trillions of dollars in housing-linked assets. The eerie thing about housing bubbles is how normal everything feels right before the fall. Streets are quiet, construction cranes fill the skyline, and home listings keep rising in price. Most people can't sense the pressure until it's too late. Yet, beneath that calm exterior, the cracks are already widening. Consider the rise in adjustable rate mortgages. After years of low fixed interest rates, many buyers in the last 2 years have turned to adjustable loans to afford rising prices. These loans start cheap but reset higher after a few years. For households already stretched thin, the reset can be devastating, a sudden jump in monthly payments that forces desperate decisions. In the early 2000s, these same loans were a major accelerant of the crisis. Today, they're quietly making a comeback. Even rental markets, which many believe are safer, are caught in the storm. With fewer people able to buy, demand for rentals has skyrocketed, driving up rents across the country. At first glance, this seems like a boon for landlords, but it hides a dangerous truth. When rent consumes more than 40% of a household's income, defaults and evictions are inevitable, and when millions are pushed out of stable housing, social unrest follows close behind. What makes this moment even more perilous than 2008 is the sheer scale of leverage. Back then, the crisis was largely confined to mortgages. Today, entire sectors of the financial system are linked to housing through derivatives, corporate debt, and even pension funds. That means a housing shock wouldn't just affect banks, it could ripple into retirement accounts, insurance companies, and municipal budgets. And yet, despite all these warning signs, the narrative of safety persists. Politicians reassure the public that regulations put in place after 2008 will prevent another meltdown. Economists point to strong employment numbers as proof that the housing market is solid. But history teaches us that stability is often an illusion, one that lasts only until the weakest link snaps. The hidden crisis behind America's housing bubble isn't just about overpriced homes. It's about the fragile scaffolding of finance, politics, and corporate power holding the system together. And the longer the illusion lasts, the more devastating the collapse will be when it finally comes. There's a strange kind of silence before a storm. It's the moment when the air feels heavy, when birds vanish from the trees, and when everything looks deceptively calm. The American housing market is in that silence now, a stillness that hides the fact that warning sirens are already flashing red across the nation. And if we ignore them, the next collapse won't just catch us by surprise. It will blindside us with a force greater than most people can imagine. Let's start with one of the clearest indicators: household debt. Across the country, American families are now carrying more debt than at any point in history. Mortgages, credit cards, auto loans, student loans, it's all piling up. In fact, credit card balances alone have surged past $1 trillion, a record high. And this isn't happening because people are suddenly spending recklessly. It's happening because the cost of living has outpaced wages. Families are borrowing just to keep the lights on, to pay medical bills, and to put food on the table. When debt becomes a survival tool rather than a convenience, it's a sign that the foundation is cracking. Then there's the sharp rise in delinquencies. Already, data shows more and more Americans falling behind on car loans and credit card payments. These smaller debts often act as a canary in the coal mine. If people can't afford to pay $400 on a car, how will they keep up with a $2,000 mortgage? During the run-up to the 2008 crash, the same pattern emerged: rising defaults in smaller forms of credit that foreshadowed the tidal wave of foreclosures to come. But perhaps the most alarming sign is affordability, or rather the total lack of it. In city after city, buying a home has become an impossible dream. What happens when a generation no longer believes home ownership is possible? The very promise of the American dream begins to erode. And when belief in that dream collapses, trust in the economic system collapses with it. At the same time, construction patterns reveal another red flag. Across many states, housing starts, new construction projects have begun to stall. Developers, sensing the slowdown, are pulling back. When builders stop building, it means they see trouble ahead. The housing market is not just about what's happening today, it's about what insiders believe will happen tomorrow. And right now, many of them are quietly retreating. Another piece of the puzzle lies in the rental market. After years of soaring rents, we are beginning to see a sharp divide. Luxury rentals in big cities are sitting empty, while working-class families are squeezed into smaller, older units with skyrocketing costs. That mismatch, too much supply at the top and too little at the bottom, creates instability. It shows a system that isn't meeting real demand, but rather chasing speculative profits, and speculative mismatches are always precursors to collapse. Then there's Wall Street's role. As corporate landlords scoop up homes and turn them into investments, they're also loading up on debt themselves. Many of these firms borrowed billions during the era of near-zero interest rates, betting that rents and home values would keep climbing forever. But now, with higher interest rates, those debts are harder to service. If rents flatten or fall, these corporate giants could be forced to sell thousands of homes at once, flooding the market and pushing prices down dramatically. This isn't a hypothetical. It's exactly what happened during the foreclosure wave of 2008, only this time it could happen at corporate scale. And what about banks? On the surface, regulations after the last crash were designed to keep them safe. But cracks are showing there too. Just this year, we've seen regional banks collapse under the weight of bad bets on interest rates. Imagine what happens if mortgage-backed securities lose value again. Even if the biggest banks survive, smaller institutions, the ones that lend to local communities and small businesses, could go under, taking entire local economies down with them. The warning signs don't stop there. Look at demographics. America is aging with millions of baby boomers heading into retirement. Many of them are sitting on valuable homes, but they are also sitting on fixed incomes. As more retirees look to sell their properties to fund retirement, the market could face a wave of supply just as younger buyers are priced out. That imbalance, too many sellers, not enough buyers, creates the perfect conditions for a sharp decline in prices. Even international factors feed into this storm. Foreign investment, once a major driver of U.S. housing demand, is beginning to slow. In places like Canada and China, economic troubles are forcing investors to pull back. That means one less safety net propping up inflated housing markets in cities like New York, San Francisco, and Seattle. Perhaps the most chilling warning sign of all is psychological. Across America, people are starting to say, housing only goes up. We've heard this before. It's the same phrase people repeated in the early 2000s, just before the bubble burst. When a belief becomes that widespread, when people stop questioning risk and assume growth is guaranteed, that's the moment markets are most vulnerable. Optimism, ironically, is one of the strongest signals of an impending crash. Put all these signals together, and the picture is clear. Debt is rising. Defaults are climbing. Affordability is collapsing. Construction is stalling. Corporate landlords are over-leveraged. Banks are fragile. Demographics are shifting, and psychology is once again blinding us to reality. Each of these factors alone would be concerning. Together, they form a perfect storm. The silence before the crash won't last much longer. The question isn't if the housing bubble will burst, it's when and how hard. And the answer to that depends on how deeply these cracks spread before the first domino falls. The hardest truth about housing bubbles is that they don't just deflate quietly, they burst. And when they do, the damage extends far beyond the people who sign mortgages they couldn't afford, or the investors who bet on risky loans. The entire system feels the shock. Jobs vanish, savings evaporate, confidence in the future collapses. And the ripple effects touch every corner of society, even those who thought they were safe. Imagine the moment the first cracks finally give way. Perhaps it starts with a wave of defaults in a handful of overextended cities. Families who bought at the peak suddenly can't keep up with their payments. Foreclosure signs begin to pop up. First a few, then dozens, then entire streets lined with homes, abandoned by owners who simply couldn't hold on. Banks react swiftly, tightening credit. That makes it harder for new buyers to enter the market, which pushes prices even lower. Corporate landlords, already carrying heavy debt, decide to cut their losses. They sell thousands of homes in bulk, often at discounts. This floods the market with inventory, driving prices down further. Panic spreads as homeowners see the value of their largest asset, often their only real source of wealth, fall month after month. At the same time, the shock begins to spread into the financial sector. Mortgage-backed securities lose value. Pension funds, insurance companies, and even university endowments that invested in these products start to suffer losses. Regional banks, heavily tied to local housing markets, face insolvency. Layoffs ripple outward, first in construction and real estate, then in retail, services, and manufacturing. Because housing isn't just an asset, it's the foundation of the entire economy. As the crisis deepens, the political fallout begins. Ordinary Americans, furious that once again their lives are upended by forces they cannot control, demand action. Politicians scramble, pointing fingers, offering bailouts and rushing through emergency measures. But as in 2008, those measures often come too late to save the people at the bottom. Wall Street survives, Main Street suffers. The hardest hit are renters and first-time buyers. With home values collapsing, many landlords retreat, selling properties to cover their debts. But instead of lowering rents, many markets see the opposite. Desperate landlords hike prices on the units that remain occupied, trying to squeeze out enough cash to stay afloat. For millions of families, this means eviction, instability, and homelessness. Meanwhile, younger generations who had been saving for a home find themselves in limbo. Houses are technically cheaper, but credit is frozen, jobs are disappearing, and uncertainty makes long-term commitments impossible. Communities suffer too. Neighborhoods riddled with foreclosures become ghost towns, their streets dotted with empty houses. Schools lose funding as property tax revenues collapse. Local businesses fail as their customer base evaporates. Crime rises, not because people are inherently criminal, but because desperation has a way of eroding social order. And then there's the psychological toll. For decades, Americans have been taught that buying a home is the ultimate symbol of success, the foundation of financial security. When that symbol shatters, it leaves behind not just financial losses, but an identity crisis. If the dream of home ownership is no longer attainable, or worse, if it becomes a trap that ruins lives, what does that say about the American dream itself? This is the hidden crisis, not just financial collapse, but the unraveling of belief. Because housing has always been more than an investment. It's been a promise that hard work, stability, and patience would one day pay off in a home of your own. When that promise breaks, faith in the system goes with it. Yet within collapse, there is also opportunity. Crises have a way of resetting the system, clearing away illusions, and forcing societies to confront realities they've long ignored. After a burst, there will be chances to rebuild, to rethink what housing should mean, to ask whether it should remain a speculative asset or return to being what it was meant to be all along: shelter, stability, and community. Some argue that this reset could open the door to reforms, stronger protections for renters, limits on corporate ownership of single-family homes, new investments in affordable housing, and stricter regulations on Wall Street speculative products. Others warn that without bold action, the cycle will simply repeat. Another bubble will form, another generation will be sacrificed, and the system will limp forward until it inevitably collapses again. The future isn't written yet, but what is clear is that America is standing on the edge of a precipice. The warning signs are here, the cracks are visible, and the silence before the storm will not last forever. When the bubble bursts, and it will, the question will not just be how much money is lost, but how much trust is shattered, how many families are displaced, and how deeply the American dream itself is shaken. And so, the hidden crisis behind America's housing bubble is not only about economics, it's about identity, security, and the story a nation tells itself about opportunity. The next collapse may expose, once and for all, that the dream was never as solid as we believed. It may reveal that the house we thought we were building on rock was, all along, built on sand. The storm is coming. The only question is whether America will face it with denial, or whether it will finally learn the lessons it ignored before and rebuild not just houses, but hope.